Welcome to Key Points for January. This month, while we're encouraged by some of the economic and inflation readings coming through, while we agree with the more assertive position being taken by the US Federal Reserve in terms of monetary policy, and why we believe that equity markets still have upside ahead despite the more volatile period at the turn of the year that we had been anticipating. Now, to the first point, economic growth coming through globally remains extremely robust. We had mentioned last month about the Delta COVID variant resulting in lockdowns in Europe that would impact near-term activity. That does appear to be the case, but underlying fundamentals remain robust. Yes, of course, the Omicron variant is very concerning given the alarming infection rates that we're seeing, but we don't believe this will have the same economic impact as Delta has had and previous waves across the globe. Now, when we look at activity, it's been very much supported by business investment, capital spending, but also fundamentally that consumers globally are continuing to spend. They typically have still quite high levels of cash on their balance sheet. Savings rates, of course, have been very high, and that is being deployed. Now, on the inflation front, while headline readings remain uncomfortably high, there is some signs that there is an improvement coming through. When we look at lead times in terms of orders and deliveries, they are improving. Some of the backlogs that we're seeing are being worked down. And importantly, some of the components prices are beginning to soften as well. So still too early to say that inflation is peaking, but we do believe that we will be able to say that as we get to the end of the spring into the early summer. We're still confident that inflation trends will begin to track lower by then. Now, one of the reasons for that is related to our second point is that central banks certainly have not lost their inflation fighting credentials. The Bank of England has already started moving interest rates higher, but we're encouraged by what the Federal Reserve are now saying and importantly doing. We had wanted to see an acceleration of asset tapering. That indeed is happening. They've doubled the pace of that and are likely to end that program by the middle of March. But they've also intimated that interest rates are likely to be hiked 3 times in the coming year, something that was penciled into our own forecast. And indeed, we suspect that first rate hike could come as early as March, given we believe that the Fed wants to front-end load its tightening trajectory, given the very strong growth dynamic and still elevated inflation readings that we're seeing. So clearly, central banks not lost those inflation fighting credentials. Now, when we turn to the financial markets, at the end of last year, we had been a little bit concerned that there might be some profit taking given the very strong performance numbers being reported over the course of last year. The S&P 500, for example, total return up close to 30% last year. Now, we suspect there's going to be further upside ahead, although the volatility is going to be, I think, a consistent theme over the course of the coming year. In the report, we speak a bit about the emerging markets, which performed incredibly poorly over the course of the last 12 to 18 months. But we do believe there's some signs that a lot of the bad news is becoming embedded in the price. Valuations are looking much more attractive than they've done in the past. And while we think it's maybe a little bit too early yet to dip our toe in the water, we do suspect that opportunities in emerging markets will present themselves over the course of the coming year. Now remember, as always, this full report can be read along with all our other publications on zurich.com/MSME.